super excited. It is absolutely beautiful. Maya and I's desks are being put together right now, and we were there this morning. Super excited. So you're going to see a whole new Western title. Look, all refreshed. We're excited. So I'm going to go ahead. We have three speakers here today. We have Milissa with our IAPX 1031 exchange, and we have David with Jaffee Services LLC, and we have Taylor with Ashland Pacific. So I'm going to let each of them, they're going to, Melissa's going to start off. She does have to take off to another presentation. And then they're going to turn it over. They're just going to go one after another. Thank you guys. I'll turn it over.
Thanks for having us. So today what we wanted to do, I know a lot of you have taken my classes on 1031 exchanges, so I'm just going to talk about some things that might be red flags where people have wrong ideas about exchanges, and just talk about some of those basic things. We're going to break this down into 35-minute segments, and then have like a 5-minute, intermission, if you will, whatever. And then David is going to talk about cost segregation, which is really important. There's a lot of tax benefits available to investors using cost seg, and there's been some changes with the new tax code change last year, and just some really great information for not only for your clients, but for you if you're an investor that you might not be aware of that's available to you. And then we're going to round out with Taylor talking about alternative real estate investments for potentially for exit strategies for investors trying to get out of the real estate game but don't really want to pay taxes, and they're not really ready to die quite yet either. So that's how we kind of are segmenting it. We did this yesterday down in Roseburg, but in that one we did it in a 3-hour class. So we're scaling it down a little bit, or maybe we're just talking faster. We'll see which it is, okay? So let's go ahead and get started. So I always want to remind people that when you're doing a 1031 exchange, you are simply deferring the taxes. There's no magic pill that automatically makes it go away. That is a common thing that I hear, oh, if I hold it this length of time, all of a sudden there's no taxes. I think they're getting themselves confused with the 121 tax code, which relates to the primary residence, which says if you own it and live in it for at least 2 last 5 years, there is an exclusion of gain of 250 as an individual or 500 as a couple. So they like to pull that tax code in, I think, sometimes, and do that. So understand it is simply deferral. You are pushing that gain forward. All right. The only other way to get away from the gain is to die. Okay. Because there's a step up in basis when someone passes away, and the estate can sell that for what the new basis is and realize no gain. But that obviously doesn't benefit your client; it benefits the family afterwards. Okay. So I never have to pay the taxes. Well, again, that's not true. If I ever sell the real estate without doing an exchange, I am going to pay taxes on that sale. You have to be careful too, because I want you to be aware that you're going to have clients who think that they have a loss and they may not. Okay, so I'm going to give you an example. And it was actually the broker that called me, and I was really glad she did. So her client bought a property several years ago through an exchange for $1.5 million. And it had a multifamily and a single family, and they actually separated the single family off of that and sold it separately. Now they're selling the multifamily for $1.3 million. Well, that feels like there's a loss, right? If you just look at it from, well, she's paid 1.5, she's selling it for 1.3, there's a loss. I'm really grateful she called me because for 2 reasons. Her cost basis is not 1.5 million. She exchanged into that property, which means her cost basis is lower based on how much gain was deferred. I always like easy math. So let's pretend when they bought that $1.5 million property, they were deferring $500,000 of gain. That means her initial cost basis in that property is actually $1 million, right? $500,000 less. So just to start with, my cost basis is $1 million. Now So be really careful. Just because it looks like I might, ooh, now you're gonna make me all go night night here. We are talking taxes here. Okay, so be really careful because gains is a misunderstanding, all right? So just, I want you to really be aware if they exchange into the property, especially their cost basis isn't what they paid for the property, okay? I love this. They'll say, I've calculated my taxes and it's not that much. Okay, maybe. But here's the deal. If they're going to buy more real estate, they should always look at doing an exchange. I had a broker who has worked with me before send some clients to me the other day. And they're selling an investment property, and yes, they are planning on buying more real estate. And they were like, well, what's the value of doing an exchange? I said, well, you're telling me that you're selling an investment property and you want to buy another investment property. Let's kind of look at how much gain you have in that property. Well, they had enough gain that they were probably looking at somewhere between $70,000 and $90,000 in taxes. Well, being able to preserve that cash, to be able to reinvest all of that in new real estate definitely makes sense, right? So that is something that makes a lot of sense. Now, on the other hand, I talked to somebody yesterday. Now, he had a lot of gain. They paid $42,000 for a lot in the Sun River area in 2021, and they're now trying to sell it for $185,000. Well, yes, that would make a lot of sense, but here's a couple issues. They have a tax liability for about $60,000 they need to figure out how to pay. And the IRS kind of coming after them, I think. Okay? Plus, if we just sold it and we had taxes, if we took out enough money to cover that tax liability, that would be fine. But reality is this person really wanted to buy a new home to live in. Alright? So in their particular case, even though it seems counterintuitive to be paying maybe about $60,000 in taxes, it gives him the freedom to have leftover cash at the end to buy a home to live in. Now, it's his decision, but if I already know I need to take out $60,000 to pay some taxes, and that means I'm probably going to have to take out $80,000 to cover that, leaving me with about $95,000 to reinvest, it probably makes sense not to and just pay all of the taxes, and now they have the money available to buy a new home to live in. They're renting. So there are times when it does make sense just to pay the taxes, all right? And there's other times when it doesn't. It's an individual case-by-case situation, okay? And I know this sounds silly, but sometimes people just need the permission to pay the taxes to do what they want, right? Because it feels terrible. I said, congratulations on how much you made on that property. Bad news is you're going to pay taxes, but at the end of the day, it's going to leave you with a nice chunk of change to buy a home to live in, okay? So talking about taxes, if they say it's not that much, let's start talking about what that looks like, okay? On the federal level, they're looking at 15 to 20%. Most people are going to be at 15%. It takes quite a number to get to the 20%. So you can figure most people are looking at 15%. Now recapture, and that's on depreciation. So they get the benefit of depreciation of the improvements, right? So we only appreciate land, but we can depreciate the improvements. And it's 27 and a half years on all residential, including multifamily, 39 years for commercial, okay? And David's going to talk more about cost then where they can get faster depreciation. But if I just sold that property and I didn't do anything, I have to recapture or repay that depreciation at 25%, okay? Then there's this tax called the net investment income tax, the NIIT, of 3.8. So if the gain with their adjusted gross income is over 200 as an individual or 250 as a couple, that tax kicks in. Then if it was in the state of Washington, I work in Washington too, so Washington, if they live in the properties in Washington, there's zero capital gains tax, okay, unless they're a high net worth individual. And then Oregon is 9.9, it's ordinary income, as is California. So both are ordinary income, okay? It can add up very quickly, right? Sometimes the depreciation is more than the actual long-term capital gains. So when I'm talking to somebody, I always want to remind everyone what qualifies holding is a gray area in the tax code.
There is case law that supports at least a 2 tax return hold, right? Not 2 years, but 2 returns. And most advisors would want to see at least 13 months because of the difference between short-term and long-term capital gains. Now there is stipulation on holding. If it's a short-term rental or I'm converting it into a primary residence, that is a 24-month hold, and that's to prove my intent. So the true test for qualification is intention. What is the taxpayer's intention? Well, it should be that they're holding it for investment purposes or use in business or trade. Whether that is, and that's both for what they're selling and buying. So I'll either be looking at both. Because sometimes what they're selling doesn't qualify, but what they want to buy will, or vice versa. Okay? So we have to look at both of those. So what does not qualify? Well, a stock or trade in other property, right? So dealer. So flips do not qualify. Remember, when someone's flipping a property, the income producing event is the resale of that home. That is their intention, is to resell that for profit. That is income producing and is considered inventory by the IRS and is not eligible for a 1031 exchange. They'll try to talk me into it all day long, but it does not qualify, okay? Then an interest in a partnership. Now that's not saying that they can't do an exchange if they hold title in a partnership. You just can't trade your interest in a partnership and do an exchange. Securities are evidence of indebtedness. I had a very sad conversation, and they heard me talk about this yesterday. About a month ago, we had a past client come back to us to tell us that they were ready to do their exchange. So we got the documents from escrow, only to discover they're the lien holder on the property. They are not the vested owner. And we're like, hey, we're really sorry. You're the lender. Well, what had happened was it was a developer, and the developer, for some reason, decided they didn't want to wait until they were done with their due diligence to buy the property from the person and made them sell it and then be the lien holder on the property. Well, guess what? He can no longer do an exchange because he doesn't own the real estate anymore. He actually needed to do it 3 years ago when he sold it to the developer. He had in the tune of $500,000 of taxes he was going to have to pay on the sale that he did now that the developer is paying off the loan. Yeah, it was not a good conversation. And I'm sure it wasn't a very good conversation that he had with the developer. We're not going to mention the developer because you guys would know the name. She says, you can't do it through a lawsuit. Okay, so this is my other cautionary note. This is where you tell your sellers do not lie on a disclosure. Okay, so I had someone who exchanged into a property in Ellensburg, Eastern Washington, a couple years ago, only to discover that the seller had lied. Because in the spring, there is the lower field floods to the point all the way up to the foundation of the house and into the crawl space. And so they went after the seller. The seller denied that they knew about it. It's like, really, guys? But not only was it physically apparent, they had been the original owners and had bought it from the builder, and they got documentation that the builder had disclosed it to the previous owner. So the previous owner decided to cooperate, and what they had to do was buy the house back from the person, including additional costs incurred by them. So they needed to exchange back out of it, and the attorney tried to provide me with the action requiring them to buy it, and I said I cannot do a transaction with that. It has to be a purchase and sale agreement. In fact, the client and their CPA, I know their CPA, we've talked about it, we both agree it needs to be a transaction, a sale or purchase. The attorney tried to argue with me that the excise tax would be more than it would be for them to pay the taxes on the gain because they would be able to do an exchange. I said, I highly doubt that. He tried to tell me not to school him. I said, well, you should talk to your client because I'm pretty sure he wants to do an exchange and I can't do it with what you're providing me with. And in a couple of days, I had a purchase and sale agreement because we schooled him. All right, stocks, bonds, or notes, so we can't do that, okay? Foreign property, I keep having people wanting to buy in Portugal. It seems to be very popular, but no, you cannot do that. It's a U.S. tax code, so you need to buy and sell within the United States, okay? A certificate of trust or goodwill for the business to another. So if someone's including the goodwill or good personal property or equipment, that's going to be separate separate it out and they will get that money at closing. We will only take the proceeds for the real property.
We already talked about dealer property. Okay, so what is a fully tax
Deferred exchange, here's another area that people have confused. Two things.
equal or greater value?
All the cash back in. If they have a loan on the property, they do need to replace that debt in some way. Okay, that can be more cash, or a new loan, or a combination of. But if they don't replace the debt, that portion is taxable. Don't get hung up on debt ratio. Just know that if I'm, say, selling for 500 and I have 300 in cash because I had a $200,000 loan, I don't need specifically a $200,000 loan. I just need to buy 500 in real estate and I have 300 in cash to do it with. Because if I turn around and buy 600 in real estate and I have 300 in cash, well, I'm just going to borrow 300,000. I'm not limited to borrowing 200 and I have to bring in another 100. See the difference? Okay? So equal or greater value, all the cash back in.
I like this.
I thought I only had the reinvestment gain and I don't get my basis back. This is very common. Okay? They want to take the house and they just want to play with the bank money, right? They don't want to play with their money. They want to take it back. Well, guess
That's
what?
what you don't get to.
Well, you can, but it's
Tax first, okay? And I get
this. I'm being double taxed. No, technically you're not. So I always tell people when your advisor is going to calculate how much gain is in the property, it's always a bottom up. Okay, so they're going to look at your adjusted cost basis. So that's what did I pay for the property when I bought it, and adjustments down for depreciation. And I love this. They'll go, I did a bunch of work on the property. I'm like, cool. Did you write it off? They're like, yes. I said, then it didn't adjust your cost basis. You wrote it off. It's like having your cake and eating it too. Okay? So I'm bringing my cost basis down. Sales price after closing costs. The difference between the two is the
total gain
in the property. By the way, remember that. That's gain. The difference
between the adjusted cost.
basis and the sales price is gain. Now, from an exchange perspective, we're going to look at it from top down. So each dollar less is going to be taxed first, then deferred. That's the trade-off with the IRS, is they're saying, hey, we want you to buy more real estate of equal or greater value, and we want all the cash back in. You don't want to do that? Okay, you get to pay taxes on it. And by the way, anything less, they're going to get you the highest tax rate first of depreciation recapture of 25% versus long-term capital gains. Okay? They can do it, but they need to be careful. Did you have a question?
Yeah, kind of. So I had a question about the recapture.
Sure.
So the 25%, that just adds to your income for that year, right? And then you tax on your tax rate of your income.
No.
Okay.
So if I have recapture, that portion is going to be there, but it can be looked at as income.
Yes. So it as far as tax rate.
So if I have to recapture $100,000, that would be $100,000 back to the government, or
No, it's
separate?
25.
Percent of the 100. So if I have 100,000 of depreciation I've taken,
Yeah,
I'm going to repay that at 25%. So I owe them 25,000.
no matter what.
If I didn't do an exchange.
Correct.
Otherwise, I'm deferring that.
Yeah.
So an exchange allows you to defer the recapture as well.
Okay, I was like, I thought we got taxed on that 25%, and you have to pay that whole 25% back.
No, so if I take 25,000 in depreciation, then I repay 25% of that.
I understand.
Yeah.
Yeah.
Am
I'm still not
So-
answering the question.
So the 25,000 for the recapture, right?
Mhm.
I have to give the government 25,000, or do I pay a percentage of that based on like my tax credit?
The percentage of how much depreciation was taken
Yeah,
of 25%. So the tax on the depreciation is a tax rate of 25%.
so I'm giving them $25,000 off of that.
If it was 100,000, yeah.
Yeah, okay.
Yep, and then you have your taxes on top of that.
Okay.
I think we got to the right place.
Yeah.
Okay.
Okay. Again, so
So we
we're
already talked about it. It doesn't invalidate, it just means that the portion not reinvested is taxable. And we call that boot. Now, the one that really hurts them the most is that debt. They're like, wait, I didn't get any cash. I paid off a loan and now I get to pay taxes on it. And the answer is yes. If you do not replace that in the new property, that portion is taxable. So my example was I walk away with $300,000 and now I just want to buy something for $300,000 with my cash. $200,000 I didn't replace is taxable. And by the way, that could be on my gain. So I could buy a $300,000 property and still owe all of my taxes. We have to be careful about how far down they want to buy down or trade down, because it can defeat the purpose of the exchange. I like this. I thought I just had to buy another property in 45 days. Those are always the worst phone calls. I'm telling you, I've had way more than I care to admit. I even had a real estate broker trying really hard for their client when escrow's like, the answer was no. And they were like, don't they just have to identify the replacement property in 45 days? That was the broker. And I'm like, no, you need to attend my class. I didn't say that, but no. Okay, I wish that was the way it is, but they have to have the exchange at closing in place. I just got an email this morning from somebody that I work with a lot that wanted to talk to me about the replacement property for his client that he sent to me. And the first thing I noticed in the email was it was closing tomorrow. So I didn't email him. I called him and I'm like, he hasn't set up an exchange with me. And the guy's on a cruise. So, fortunately everything can be done electronically. But he goes, he told me that he's already signed all the documents. I go, well, he could have set it up with somebody else, but not with me. Because he never got back to me. And he didn't know it was closing tomorrow. Today, yes.
Sorry, just to get clarification.
Yes.
They just need to set up the exchange before closing, but they still have after closing the 45 days
Yes.
to purchase.
So the time frame on the exchange doesn't start from when they're in contract or even when they engage our services, both questions which I've had. The timing on the exchange starts when they close on the sale, and it actually starts the day after. Okay? So they have 45 days. They also think escrow does it for them. Or my favorite, my broker took care of it for me. I had one of these. It was somebody had been sent to me like a year ago. All of a sudden, I get an email from escrow that's for this client. I'm opening it up, and then I realize, wait, this is a purchase, not for sale. So I'm reaching out to her, and I'm like, hey, I see this is for a purchase. I don't have an exchange set up for you yet. Like, where's your property that you're selling? And, or have you closed it already? You will already have an exchange in place, because people sometimes will think they need a QI on both sides. So unlike escrow, we handle both sides of the transaction, both the sale and the purchase. So they don't need to hire someone for the sale and then someone for the purchase. It's a one-stop shop kind of thing. We do both sides. Okay? So I was thinking, oh, maybe she thinks I need to help her with the replacement that she already has to be for the relinquish. She's like, oh, I closed in December. And I'm like, well, if you have your money, then that means you have no exchange. And she goes, oh, and her email is, my brokers always take care of that for me. Obviously not. Yes, sir.
If I have a lease with an option on a piece of property and I sell it to you, and I would exercise my option on the other piece, that purpose is closed here, so.
Yeah, in fact, you could sell that option and exchange out of it.
Okay.
Yeah, so you can execute the option and then sell, because you've had it for that length of time. Or you can execute the option or sell the option. So you can either sell the option on assignment or execute the option and sell it. So, and exchange out of it. Anyway, prior to close, that is the deadline. We've done same day. I guess I'm probably doing that tomorrow. So, well, someone's on a cruise. I wish I was on the cruise and it was just Quintus. He was here. He's on the cruise. Okay. It is not flexible. Okay. This is not like, well, no. Between the two things that are the most important in an exchange, this is the second. The first is that exchange must be in place before close of escrow. The other phone call I get is, I closed last week, I got the check from escrow. Because they have in their mind, if they don't cash the check, they can do an exchange. Guys, that's legal tender. That's not constructive receipt, that's actual receipt. Okay? Now, that is not a flexible date, and that is the most important deadline in the entire exchange. Forget about the 180 days. Yes, that's important, but it's really the 45-day deadline to identify that's critical. So open up the exchange before close of escrow, and the 45-day deadline is physical days. So I've had people make the mistake that their 45-day deadline was on the weekend, so we decided to identify on Monday despite our numerous attempts to try to get a hold of them, to get it to us. We like to see it beforehand just in case we need to fix it. And so he sent it to us on Monday, and we said, "Really sorry, we have a failed exchange. Let us know how you want your money back." Okay. 180 days. They do have 180 days, but keep in mind, once they identify on day 45, that's the only thing they can buy. So they're going to have something in contract, and unless it's new construction or a big commercial transaction, they're going to close well before 180 days hit. Now, we definitely hit up to that 180 days on occasion, like the nail biter deal, but most are going to close within the first 45 to 70 days. Okay? If the 180th day, by the way, is on a holiday or weekend, they must close the business day before, not after. Now, most of you have probably heard of the free property rule, and that is because most people buy one property of a similar value. So that's the most commonly used rule. How am I doing in time, guys? Probably running over.
10:32.
Okay. Most commonly used rule. Okay. That's because most people buy one property of a similar value. 200% rule. This is if somebody's going to buy several less expensive properties. This rule says rather than you being limited by the number of properties, you're limited to the combined value not to exceed twice the value of what you just sold. So if I have someone, like the gentleman who doesn't have an open exchange, he's going to use this. He's selling for $1 million. He's buying 4 different properties. He's going to use the 200% rule, which says he can identify an unlimited number of properties, but the combined value does not exceed $2 million, twice the value of what he just sold. I'm going to put the 95. You get a copy of this. So you're talking about if I have a ground lease, as long as I have at least 30 years left on it, I can exchange in or out of it. Cell phone tower perpetual easement. So I have someone right now that's selling a farm in California, and they're segregating out the easement that they have a cell phone tower lease agreement on. So they are exchanging the easement for about $3 million, and that is including the lease agreement with the cell phone tower. Usually it's cell phone companies that are buying the easement versus having the lease anymore, but in this case they're selling the farm and the easement to the same party, but they're separating it out as 2 transactions because they're not going to exchange the farmland, just the easement. Okay? Now, Lifetime is nice because I don't have to buy the same thing. They're going to buy single-family rentals. So Lifetime is not single-family to single-family, commercial to commercial. Lifetime is simply this. You're selling real estate, you're buying real estate, and what you're selling and buying is for investment purposes and for use in business or trade. That's the like-kind element, not the property type itself. So that's really nice that they can sell this easement, but they don't have to buy another easement. Okay? And then you can buy as an individual and then buy as a tenant in common, but you can't buy in through a partnership because they have to follow the same taxpayer rule. So like syndications do not work well for someone doing a 1031 exchange because they've set up a partnership and they're trying to get investors into that partnership through the syndication. It would have to be a tenant in common or a TIC holding because I have to maintain the same taxpayer. Okay? And we can have riparian rights, except for not in Oregon, we can't own riparian rights. The state of Oregon remains ownership of that, right? But in Washington you can, as you can in California. So it depends on the state. The mineral rights, timber rights, air rights, and development rights. I've actually exchanged air rights. They gave us a legal description, so we exchanged it. All right, well, I'm gonna stop here, and David is gonna come up next. I'm really, thank you guys. I know it was a lot. And the other 2 gentlemen, and we really appreciate your time today. And now I get to drive like a crazy woman back to Vancouver. Oh, for an AI event. Oh. I'm gonna learn all about how AI is replacing
courses and how they do the study, what else you get with the study. So it's something to know about, but I will give you guys the basics. How many people in here own rental real estate themselves? Okay. Have all of you guys done cost segregation? Don't say anything. What I'm going to tell you about a number of things, and this slide deck was designed to be too many slides for a full hour class, and I've got even less than that. So be aware, this is on purpose. I'm going to give you concepts or saying this is the regulation. If you care about details, be aware that you'll get the slide deck. So I'm not going to spend time reading slides. I'm going to give you a big overview. Not only cost segregation itself, but the tie-in to various other things that you need to be aware of because they affect other things and give you additional deduction opportunities beyond cost segregation. But cost segregation itself is the basis for all this stuff. Oh, good. I want you guys to be educated for two reasons. First of all, you guys will save a lot of money personally knowing this, anybody who's got rental property. But the other thing is you will stand out as a vendor, as a broker, as an advisor, a trusted advisor by being able to say, hey, there's money available, you should know about it. Hey, there are requirements, you are subject to fine if you are not compliant. So, quick overview. Cost segregation is actually very straightforward. It's also one of the logical things in the tax code, in my opinion. IRS lost a huge court case in 1997. That's why it existed. In a nutshell, the Hospital Corporation of America said, look, my building, you let me write it off in 39 years, yet I'm replacing the carpet every 5. Lots of stuff in here wears out faster than cabinetry, the driveways and all of this stuff. The court ruled absolutely true. IRS needed a way of allowing people to write off things faster, again, effectively because they wear out sooner. So a process was created called cost segregation, and in a nutshell, what we're doing, your cost seg guy goes into a building, explodes it into pieces, and assigns costs to all the pieces. So literally the built-in cabinetry and the flooring of vinyl or carpet or whatever. And what about the plantings? What about the hardscaping? The swimming pool, all pieces of buildings, all improvements. Because remember, land, as Melissa said, only appreciates, you can't depreciate. So as a rule of thumb, 20 to 30 some percent of all the dollars you spend for the building can be assigned to a shorter tax life. So then magically what is going to happen is rather than $1 million building being divided into 27.5 or 39 equal deductions over the tax life, all of a sudden you've got up to about a third of the building, which can be written off significantly faster. If you're graphically inclined, under all of these lines is the same amount of area, and that is all the dollars paid for the improvements. Remember, if you pay $1 million, you have to take out land. But these are the ways of doing depreciation. Straight line depreciation, you get the same amount every year till you get to the end. What cost segregation does, before the enhancement I'm about to mention, is it does this. The very several first years, you're getting significantly more in write-offs, and then it has to go less going forward because when you get to the end of the tax life, you have to have been able to depreciate the exact number of dollars, no more, no less. Now, this, before anything changed, made a lot of sense. This pencils out. This is a pure time value of money play. All of this area here that got scraped up to here, this is you getting deductions early. This is you are being able to take the deduction now, use the money productively, and this deduction you got here instead of here, what's a dollar deduction worth in 25 years? Well, we've got factored in inflation. And so taking them up front, everybody wants the money up front. It's such a no-brainer that the IRS says, as a practical matter, cost segregation studies should be applied by taxpayers. So don't worry that it's a loophole or not going to stay around or anything else. It is for real. And the cool thing is it offers additional benefits too, which is the second half of the presentation. Now, when Trump came in the first time, and now he has renewed it, he created something called 100% bonus. The idea being, hey, all the stuff your cost seg guy finds, forget about writing it off in 5 or 7 or 15. We're going to have it today. In fact, if you buy on December the 30th of 2025, and your cost seg guy finds 30% of your building, of the cost, can be put into a shorter life, you can take a 30% write-off up front. You have accelerated depreciation, and you put it on steroids. And that's what you're seeing in the green line. A gigantic amount the very first year, and then future amounts that, let's say, we find 30%, great. This is 70% that's still spread over the life, the tax life of the building. So if someone says, oh, I don't want to do bonus because I'll use up all the depreciation, I won't have any in the future, they're misunderstanding. Let's say we get 30%, and let's say they take bonus and use it all up. It's still 70% of the dollars spent on the building. It's the normal function. In a nutshell, sort of the shell of the building you can't speed up, but lots of the pieces of it you can. And your cost seg guy is the one who goes in, figures out how much this much carpeting is worth and what that kitchen setup is worth, etc. And then the other big thing to know is they say this is for commercial property, and it is. But commercial property does absolutely apply to residential if you're making money on it. So, if it is a single-family house that's rented, yes. If it's an ADU that's rented, yes. If it's a condo on the beach that's rented, yes. You can use cost segregation. You're claiming the income, you get to depreciate. In fact, you're required to depreciate, which sounds a little odd, but it's true. If you don't depreciate, you want to, and you want to, all the write-offs you can get as soon as you can get them. The IRS actually is allowed to take them away if they come in and say, boy, did you mess up, we're spanking you, and that's one of the ways they can spank you. So that is bonus. It was reinstated with the most recent Trump tax bill. It was 100% from 2017 to 2022, and then it's coming down, sunsetting at 20% per year. So in 2023, you could bonus 80% of what your cost seg guy finds. Now, there's an issue of whether you can use it all at once or not, but the fact is that it would be available to you. And it's locked to when you bought the building, not when you finally learned about cost segregation. So if you go back and tell one of your clients today who bought something in 2022, hey, I heard about cost segregation, you should look into it, see what you can save, because they put it into service in 2022, they qualify for 100% bonus. Whereas somebody who bought it in 2024 only qualifies for 60% bonus. And oddly enough, if they bought it in 2025, between January 1 and January 19, it's down to 40% bonus. Because Trump said, yeah, I'm going to change it back to 100%, but not for those 19 days where I wasn't president. So if you bought on January 20th of 2025, you qualify for 100%. But if you bought between the 1st and 19th and the compliance, that's 40%. That is politics, folks. Feel free to jump in and interrupt me, by the way. A page on what level of bonus applied and what you, again, lock to when you put it into service. There are several reasons you may not qualify for bonus. For example, you rented the space before you bought it from your landlord, stuff like that. Several reasons if you care, it's in the slides. Now, 1046, not bad, I guess. Okay, here's the other cool thing about cost segregation. It's actually the building block for how the IRS has you determine whether a repair that you make on the building is big enough that you can't write the whole thing off the year you do it like you want to. You want to take every expense you can as soon as you can, so it's your money you can use. But there are repairs that are too big or too much better. You're not allowed to write them off. You've got to add them to the depreciation schedule and depreciate them. The beauty of cost segregation is, at least with my company, you get an extra report that lets you do it. Because the IRS made this change in 2014, and they said, hey, there's several things in addition to this, but fundamentally, if you spend less than about a third on repairing a building system versus the cost to replace the system, you can write it off without worrying about it. So back in the day, if you spent 50 grand repairing a roof, your CPA might say, oh, I don't, whatever, hey, we expense everything, what are they gonna do, catch us? And others say, 50 grand, you can't write that all off this year, it's just too much money. Now there's actually a way of figuring it out. If you've got $200,000 roofing system, and it's not just the shingles, we're talking sheathing, we're talking trusses, we're talking decking, that's a building system. Well, if you've got a $200,000 building system and you spend 50 grand on a repair, that's 25% of replacement cost. I can write it off. I'm supposed to write it off. In fact, if my CPA makes a mistake and doesn't write it off, then two things can happen. First of all, my company can come in and say, guess what? You were supposed to write it off, and yeah, that was 2 years ago. We can pull the rest forward into this year and give you a current year write-off from prior spending. Because the law said you were supposed to write it off in full. You didn't. We caught it. We'll help you. You get the remaining dollars that you haven't taken yet and appreciated for 2 years. You get the rest this year. So that's one thing that can happen. And the other thing that can happen is you get audited and the IRS says, you idiot, you were supposed to write that off in full. You didn't. You lost the opportunity. You're no longer allowed to write it off. I don't know how often they spank you that way, but they're allowed to, and they now audit the repair regulations. I put one page in the center of every table that actually shows a printout from the IRS audit technique guide. This is what they give their auditors, and they say, hey, cost segregation is great, it's awesome, it's important people use it. By the way, it's really important for the repair regulations and figuring out, hey, can I write off this repair, or do I have to capitalize and depreciate it? And this goes to their auditors, so they are looking at this. So you want your person to be your person, your client or yourself if you're the owner, to be compliant, as well as the fact that this is in the taxpayer's interest. They have made it easier and more available to write off. They also made it retroactive. The law didn't take effect until 2014, but believe it or not, if you will say the same 50 grand, you capitalized 50 grand repair on your roof in 2010, and under the new rules that didn't exist then, you didn't have to, they still apply. So my company can still reach back and pull that forward, get you compliant, and whatever remaining value is on that, get you an extra deduction for that. This is above and beyond cost segregation. Cost segregation is a pure time value money play. It gives the data for this. Because what is a cost segregation study when you boil it down? Where the rubber meets the road, it's just a new depreciation schedule. The depreciation schedule used to say $1 million building and $250K of land. Now it says $750K building, $250 of land, and $250,000 comprised of these 45 line items. The vast majority of which are magically now 5-year property. And then there's also a little bit of 7 depending on the building, and 15-year is land improvement stuff. So parking, paving, hardscaping. So once you've got this, you've got the raw data necessary to be compliant. Well, my company adds a report where we add all the components like the sheathing and the decking and the trusses, and that's your roofing system. And there are, I think it's 13 systems that are part of the building. And this is, and that's what it looks like. Basically, you're gonna have two things here. You're gonna have a depreciable cost and you're gonna have a current replacement cost, okay? I can't see the time. What's the time? 10:52. 10:52. Okay. So, depreciable cost versus current replacement cost. This says that here's a roofing system. Roofing system is 132 grand. So you look at about a third of that, and you can spend up to that and just write it off and not have to worry about it. Now, there's other components involved, like is it an adaptation or a betterment or an improvement? If you're going to go from shingles to standing seam metal, that's an improvement that you're forced to capitalize and depreciate. But that's something that once somebody's done a study, at least with me, they can call me up and say, hey, how do we treat this? And I help them afterwards because they sort of own me at that point. And so there is that. And be aware, cost segregation does not have to be done in the year that you buy the property. And in fact, it pencils out for usually at least a dozen years. I did an analysis 3 weeks ago now. 20 years this guy has held the property, and yet because of the type of property, we were still able to pull out an extra $248,000 deduction, sped up deduction, after 20 years, which was, and at a surprisingly huge ROI, 20 to 1 ROI. It's just a complete no-brainer. But what happens is, whenever you implement it, whatever you should have gotten by doing it from day one and you've fallen behind, it actually comes up to a current year deduction. Because there's a form that's done that's complex math that says, hey, IRS, if we had done this in 2015 when we first bought the building, here's where we would be, but we only depreciated this much, so all the extra that we're missing, you get a catch-up deduction. Because the IRS doesn't let you do straight line for a while and then switch over. Fine, switch it over. But then there's this form, change of accounting method, that says, here's all the math, here's where we would have been, because you can't depreciate 2 different ways. So what this also means is you do not amend any tax returns. And because the IRS actively recommends it, you do not flag yourself for audit. So, yes, sir?
What about the opposite? If you actually took too much deduction in like the first year, you were supposed to like depreciate that out a little further. Can you just take away? Is there a way to like reverse cost segregate to like not have to amend and have that liability?
Yes. Well, you wouldn't reverse cost segregate exactly. What would happen is you would make corrections to the record. So the other beautiful thing about this change of accounting method form, it's used to make corrections before you get caught having made errors. So if in fact you go, oh geez, I put the wrong depreciable basis, or I took too much for this or not enough for that, or even my CPA never told me we had to claim this and depreciate it at all. All those things can be fixed on this, it's called an IRS Form 3115. So the IRS, it's good. If you correct errors before the IRS finds them, no harm, no foul. It's once they find you and audit you that they get to spend you. So yeah, all kinds of errors like that you can fix as well.
Even if they took if they claimed a lot as a write-off versus when it should have been depreciated, is that fixable still then, or is that?
Well, that is fixable. The thing is, what you're going to give me as a vendor is you're going to give me the depreciation schedule to do the cost seg on. So if you did a $50,000 roof repair and expensed the whole thing, it doesn't hit the schedule, so we don't know about it. So we're not going to know and be able to look back and say, oh, 50 grand is too much, you should have capitalized that. So that we won't catch unless you want to work with us and say, by the way, look these things over too. Because at that point, yes, you can fix that. What tends to happen instead, we find somebody put the 50 grand on the schedule, and then we go, actually this building is so big, 50 grand, you should have deducted it. And that's when we go, yep, we're going to take it off the schedule. Okay? Lowering your basis, don't forget, not only does it create an extra deduction right now, it lowers your basis, so when you end up selling, you actually have more that's taxed as capital gain and less as depreciation recapture, right? Yes, sir.
So does CSSI, is everything on your website as far as what all services you do and costs and everything?
Services, yes, mostly, but not fully, because most people don't know what a pad is. It's something I'm going to get to in a second. Costs, just like anything else, vary with how much work is involved.
Sure.
So it's a combination of what type of building and how big of a building. A small warehouse is a heck of a lot less work than a large medical office, for example. But we give you the cost up front. It's a flat fee. We try and actually underestimate the savings. So very often our high-end number is what it is or even more. So for figuring out purposes of ROI, but you need to submit just 4 pieces of information to me, and then I'll be able to say, oh, that's a $3,100 fee, or that's a $5,200 fee, or whatever.
And I notice it's a 503 phone number, but do you have people in Eugene, or is it all through Portland?
Well, actually, I guess I should tell you about the company. We're a gigantic company based in Baton Rouge, Louisiana. We've got a couple hundred reps. We've been around since 2003, and this year we're going to pass 60,000 of these tax studies. I'm physically in Portland. I am not limited, nor is the company, to any particular location, so send me anyone. There's no territorial restrictions or anything else.
Thank you.
This is anywhere in the US and Puerto Rico. There's even options for overseas, but it's different. It's not nearly as lucrative, and I've not done one of those yet, but if you're adventurous and somebody says, hey, I got this rental in Portugal, maybe, just run it by me first. Just don't file your taxes for 25 knowing that this stuff is available. I am such a great reason to call old clients you haven't heard from, or prospects that seem to have gone nowhere. I mean, if this really pencils out for 10 or 20 years, somebody you sold to a long time ago, you could say, hey, Bill, did you ever do cost seg on that thing? Sir?
Yeah, do you have to recapture the excessive depreciation if you sell the thing?
Yes, so let me tell you how that works, because there is a bit of a difference. Just like with straight line depreciation, if you sell it and don't roll forward, yes, there is recapture of depreciation. Now, with the whole 100% bonus, put everything on steroids situation, they did make a change. If you do 1031, I think that's jumping ahead. If you do a 1031, yeah, I gotta go back to that one. Then they made a change. 2 major changes. Number 1, when you do a 1031, you can't roll everything forward anymore. Okay? What we've done is pull $1 million in real property, and now it's $750K of real and $250K of personal property is what they call it. We can roll forward the shell of the building. You can roll forward all the stuff on the outside, all the land improvements. Okay? You cannot roll forward the 5-year stuff. There's recapture. So that's issue number 1. Issue number 2 is the recapture from cost segregation. Recapture of depreciation from cost seg is based on whatever your tax rate is, not that flat 25% number. So if you don't do cost seg and you sell, you don't roll forward, it's 25% on whatever depreciation you paid. Now remember, you took those deductions against whatever your income level was at the time, your marginal rate at the time. When it comes to payback, if you didn't do cost seg, it's a flat 25% of whatever those recapture dollars are. If you did cost segregation, then it's actually added to your taxable income. So you're going to pay not 25%, but whatever taxable income you had at that point. So you would think that might say, don't do cost seg if you're gonna 1031, but in fact, no. It's just like 1031. If you're gonna start doing 1031, you're gonna wanna keep doing it on all future properties. You're gonna wanna keep rolling forward. Same with cost seg. Gives you a gigantic deduction, but then there's recapture. Do cost seg on the next one. It gives you a gigantic deduction, which is going to, in effect, help to offset, hopefully, and then some, all of the recapture that you were just subject to. The one thing you don't want to do is sell the old one in the end of 25 and then buy the new one in 26, because the recapture takes effect when you make the sale. The big deduction from cost seg takes effect the year that you do it. So just don't split the year divide, and it's in the same tax year and you're good. Yes?
So that was actually my question earlier, and I don't think it was translated. So instead of paying taxes, do you pay taxes on the 25% on the 70, and then on the 30 for the cost seg, then you get to put that as your income, or a full depreciation schedule?
Okay, so if you do a cost seg and we give you a giant deduction, that goes against your taxable income at whatever your income rate is. If we're talking, you sell it, and so there's recapture whether it's straight line or accelerated, you just have a whole lot more. But if you depreciated 100 grand through time without doing a cost seg, that 100 grand recapture, flat 25 G's to the feds, right? 25% period. So you're gonna keep, so that's what it is, regardless of what your marginal rate is. If in fact you've got 100% to recapture after cost segregation, it's as if you made 100,000 extra, because it's taxed at whatever your rates are.
Yeah.
Yeah?
That's where I was confused earlier.
Yeah.
Yeah,
Yeah. Okay. So, but that is clear now.
I think so.
So if I do a cost seg and just make numbers, I would say $50,000 worth of depreciation.
Good.
Right? With this 100% at year one, can I actually take that depreciation over, say, a 2-year period instead of a 1-year period?
The answer is sort of. You can't allocate it the way you want to. You have to use everything that you can, but there are ways to push some out if you want. For example, on bonus depreciation, you can say, oh, I get this giant bonus. I don't want bonus at all. And you saw that hump where next couple of years, if your income is going up, that's probably smart, because in the next couple of years, you want these giant incomes, bigger deductions. But you can also opt out of bonus on a flat space. You can say, yeah, bonus is great, but I'm not taking bonus on 15-year stuff. So you can push part of it out. But otherwise, basically you have to use as much as you can use. The beauty is whatever is left rolls forward as many years as it needs to, so you can use it. It does not.
So like if I only have, say, $30,000 worth of tax obligation, I could use that $30,000 year one on the tax obligation and then have 20 left over for next year.
Exactly right. Yeah. Am I cutting into your time yet?
You're good.
Absolutely. Okay, so I need to tell you about 2 other things. The first one is the biggest thing where tax law and reality go 2 separate ways, and that's the partial asset disposition. Another cool thing from the repair regulations is if you do a renovation and you throw away parts of your building, I can probably get you a deduction beyond cost segregation for what you just put in the dumpster. The idea is you buy a building, I'll make it easy, you buy a building, that building is new to you, I don't care if it was built in the 17th century, that building is new to you, you depreciate based on what you just paid minus an allocation for land, right? Let's say that the roof is on its last legs, it lasts a year, lasts 3 years. You bought a building that we'll say has a 27.5-year tax life, right, residential rental. That roof, the IRS doesn't know anything about the roof, but it was new to you, it was supposed to last 27.5 years, just like the whole rest of the building. If you have to tear it off in a year or 2 or 3 or whatever, they figure you've just thrown away a whole bunch of those remaining years, you've thrown it away. And you actually get to take the deduction for the undepreciated amount of that roof. We'll come in and do a cost seg study. We assign a cost to the roof. You tear off the roof, you put on a new one. Well, 2 things. First of all, a new roof, you can't expense that as a repair. You've got to capitalize it, depreciate it. It's fine. You also can't have 2 roofs on your depreciation schedule. It doesn't make any sense. So you're actually allowed to take off the remaining value of that roof, even though it went in the dumpster, even though you wouldn't throw it away if it were still a useful roof. You've thrown away useful life and you get a big tax deduction. Of everything I've told you about, this is the only thing you have to do the year that it happens or you lose it. Everything else we can do a look back, and at some point it doesn't make sense anymore, but it does for a long time, so check. I'll give you a thumbnail in a second. But this guy, if you have anybody in here that's done a meaningful amount of renovation in 2025, call them up, say, don't file your taxes until you have this looked at to see whether it's big enough to justify the expense of getting this partial asset disposition. Okay? Everything else I'm telling you about, no time limit, it's just whether or not it pencils, and that's free to find out. Yes, sir.
Are you gonna go over the type of income that you can?
Yes, and that's, I hope to get there, because I know that's a really important thing for you guys. So, the thing about cost segregation deductions are, they are passive deductions. Now, what does that mean? That means if you're a dentist and you own a rental house, and I give you a $200,000 deduction, which is not at all uncommon, you can't use a $200,000 deduction against your dental income. That's active income, I'm handing you a passive deduction. So what can you offset with my deduction? You can offset rental profit, and you can offset passive income, not stocks and bonds. That's passive indeed, yes, of course it is, but that's not what I mean. If you are the minority shareholder in the tire company down the street, you don't make any management decisions, you just get a check, that's passive income. So I can offset that. Two giant distinctions, that's not the right, what's the opposite of limitation? Two exceptions. Two exceptions. Number one, you guys. If you guys claim that you are real estate professionals for tax purposes, this isn't just, I'm a broker. There's a series of rules, and again, I put it in here so that I don't have to read the slide. If you qualify and your CPA says, hey, IRS, Bob is a real estate professional for tax purposes, all of a sudden, you don't have this limitation. All of a sudden, your cost segregation deduction can offset your other sources of income. So that's a huge thing. Regular people, though, also have an option, and that's why you hear about a lot of people starting short-term Airbnb rentals. Because if you do an Airbnb rental, and you do enough hours personally for it, there's 100 hours, again, there's pictures in here so you know the rules, it's not passive activity anymore. It's active. So if I give you a $200,000 deduction from cost seg on the Airbnb that you manage, pow, you can offset dental income, whatever. So a heck of a lot of people are doing that. They're building an ADU, and they're saying, hey, get me a cost seg study because I want to offset my other income. So if you have someone that has rentals, the other thing is be aware it's not locked to a building. If you got somebody with a portfolio of 5 buildings, they can probably do one cost seg study, offset all the income from the entire portfolio. So again, it's worth it to get a free look, see how much is he likely to save, David? What's the cost? What's the ROI? I mean, when I only send someone an ROI of 4 to 5 to 1 after tax, I'm disappointed. I send out 30 to 1, 50 to 1 ROIs. Within the past month, I've sent out 172 to 1 after tax ROIs. It's almost embarrassing, actually. And of course, the higher the marginal rate you pay, the more a dollar deduction gets you. But my fee is tax deductible as a business expense, even though I started for the IRS for a living. So I want you guys to know that that's out there. So the regular thing is regular people offset rental income, even across the entire portfolio. You guys, if you're a real estate pro for tax purposes, offset your income from anywhere. You got somebody who wants an Airbnb so they can take giant deductions, because I create giant deductions, then yes, if they do at least 100 hours and the other things in this slide, then you can get them there, and they can do that. And again, real estate pro details, short-term rental details. You only need one material participation thing. The last thing I'll say is, if you guys have sales listings, I'm happy to create snapshots for your listing, where if you're going to sell to an investor, you can not only say, hey, it's a whatever multifamily 6.5 cap, but look what you'll get if you do cost segregation. If you pay full price that I'm asking, and you put it in service in March of 2026, in this case, I did this for a $670,000 listing of just a single family rental in Sisters. I figured out the depreciable basis, which is 405. we're likely to get them an extra $86,500 deduction on top of what they would have gotten just by doing straight line. If they're paying a 37% rate, that's 32 grand in their pocket. In this case, it's a 15 to 1 ROI. So hopefully you would use that and say, by the way, Bob, not only is it a good cap rate, look at all this extra cash we get. So I hope if anybody wants that for their sales listings, I'm happy to do it. I have one other on here just to show you. This is a $2.5 million building. Look at this. If they buy it in May, it's a $702,000 extra tax deduction, unless we go above. We frequently do. What's the after-tax ROI? 50 to 1. Nobody in the right mind would pass it up. All the big buyers know about this stuff when they use it. I want you guys to know about it because I want the little guy getting some of these bloody deductions too, and not just the Donald Trumps of the world. And again, I'm happy to make these snapshots, send me your offer memorandum, and I can do that. I'm here for questions whenever. Otherwise, it's tea time. Yes.